On February 6, 2026, Bitcoin prints $60,008, and the entire Trump rally story is erased in a single, grinding cascade. In 1 week, roughly 14% is wiped out, and the sell-off is not clean, not orderly, and not explained by a single headline. While crypto timelines argue about narratives, a quieter signal sits in plain sight. BlackRock's ETF channel becomes the easiest exit, and the exit becomes the event. And if you're using Bitcoin as an inflation hedge, this changes everything, because it shows you what happens when the hedge is forced to behave like a risk asset. What if everything you believed about Bitcoin's independence from Wall Street was wrong? There is a reason the collapse lands on a specific number, on a specific date, with a specific shape. Price does not move in a vacuum. Price moves through plumbing, and plumbing determines whether stress becomes a bruise or a fracture. This unfolds in 4 stages. Stage 1 is liquidity expansion. Credit is loose, leverage is tolerated, and the trade is built quietly because every dip is absorbed. Stage 2 is financialization. The asset is repackaged into wrappers that trade faster than the underlying can settle, and the wrapper becomes the primary tool for exposure. Stage 3 is reflexive unwind. Risk flips, exits are synchronized, and hedging flows push the underlying in the same direction as the selling. Stage 4 is absorption. Leverage is reset, weak hands are cleared, and the system stabilizes under new margin, new risk limits, and new rules of engagement. This isn't prediction. This is pattern recognition from a century of market structure repeating under stress. Throughout modern financial history, every widely held asset class that becomes a fast-traded wrapper product follows the same sequence. The names change, the ideology changes, the sequence does not. The first proof is not crypto. It's October 19, 1987. In a single day, the Dow falls 22.6%, a collapse so violent it forces the world to admit something uncomfortable. Protection can become selling. Portfolio insurance is designed to reduce losses by dynamically hedging. But dynamic hedging has a hidden logic. When prices fall, the model demands more selling to stay hedged. The selling pushes prices lower. Lower prices trigger more hedge selling, and the loop feeds itself. In calm conditions, it looks like safety. Under stress, it behaves like gasoline. The important detail is not the headline number, it's the mechanism. A rule-based hedge turns a market into a chain reaction because everyone's risk control fires in the same direction at the same time. That is stage 3, reflexive unwind. Now move forward to May 6, 2010, and watch the same structure reappear with different technology. The flash crash unfolds in minutes, and roughly $1 trillion in market value evaporates temporarily, before partially returning when liquidity reappears. For a brief window, the market is not a market, it is a vacuum with prints. The story is not that computers are evil. The story is that speed outruns discretion. When liquidity providers step back, the wrapper products and the hedges trade against each other, and price is forced to clear at extremes. Same pattern, same stages, same outcome. Then comes March 2020, when the world demands one thing: cash. Even high-grade credit wobbles, corporate bond ETFs trade at discounts to their underlying bonds, and the difference between a liquid wrapper and illiquid collateral becomes visible. The wrapper can trade all day, the collateral cannot. In that moment, policy steps in, liquidity is backstopped, and the system stabilizes. 3 different systems, one repeating truth. The wrapper can amplify stress when everyone tries to use it as the exit. Bitcoin's $60,008 collapse on February 6, 2026 is not a crypto story first. It is stage 3 pressure arriving inside a financialized Bitcoin ecosystem, where ETFs, futures, options, and leverage interact in real time. Start with what the tape confirms. Bitcoin trades down to $60,008.52. The weekly damage is roughly 14%. Large enough to force margin calls, to trigger liquidations, and to flip sentiment from confidence to defense. The question is not whether sellers exist. Sellers always exist. The question is why the move accelerates. why the intraday path fractures, and why the bounce looks mechanical. The answer is microstructure. Bitcoin used to be dominated by spot exchanges, retail flows, and a fragmented derivatives layer. Now it is financialized. A major portion of new access arrives through U.S. spot Bitcoin ETFs. An ETF is a wrapper designed to trade like a stock. That convenience is not free. It rewires how exits happen. The ETF layer introduces two critical features: intraday tradability and professional hedging. Intraday tradability means exposure can be sold instantly by anyone with a brokerage account. Professional hedging means liquidity providers respond to that selling by trading the most liquid instruments available to neutralize risk. In a risk-off event, the hedge is not a gentle adjustment. It is pressure, applied fast. Here is the trap. Many investors assume ETF liquidity is new liquidity for Bitcoin itself. In stress, ETF liquidity can become borrowed liquidity, and borrowed liquidity can be recalled. An ETF share is not a Bitcoin. It is a claim on exposure managed through a creation and redemption system. When demand is strong, shares are created and the wrapper expands. When selling pressure dominates, shares can be redeemed and the wrapper shrinks. Shrinking is not just a bookkeeping detail. It changes how supply is expressed into the market. Now apply that to the specific window the market just lived through. Across November, December, and January, the spot Bitcoin ETF complex experiences sustained net outflows totaling more than $12 billion. The sequence is roughly $7 billion in November, about $2 billion in December, and more than $3 billion in January. That is not a single bad day. That is a multi-month reversal in marginal demand. Multi-month outflows do something subtle. They remove the passive bid that turns dips into quick recoveries. They force the market to lean more heavily on discretionary buyers, and discretionary buyers disappear when risk goes off. Now combine that with February 5th to February 6, 2026. As price falls, the ETF becomes the cleanest institutional exit because it trades instantly, at scale, with familiar infrastructure. When the ETF becomes the exit, market makers absorb the shares, then hedge the exposure. Hedging does not require belief. Hedging requires neutrality. Neutrality is achieved by selling what is liquid. In the Bitcoin ecosystem, that typically means futures, options, and spot where available. When volatility rises, hedging becomes dynamic, and dynamic hedging is reflexive. The hedge grows as the move grows. This is the same mechanical logic that turned protection into selling pressure in 1987. It is the same logic that turned a normal sell-off into a vacuum in 2010. And it is the same logic that revealed wrapper versus collateral stress in 2020. The asset is different. The mechanism is identical. Now bring in the phrase $847 billion transfer, because it sounds like a conspiracy until the arithmetic is understood. This is not a single wire transfer. It is not one account moving $847 billion in cash. It is notional risk moving through the system, exposure being shifted, hedged, and reallocated across the ETF, the derivatives layer, and the underlying. When a large wrapper becomes the primary trading venue, the notional exposure that changes hands can dwarf the net flow. Net flows are the water level. Turnover is the current. During stress, the current can become a riptide, pulling price through thin spots even if the water level looks manageable. If an ETF complex sees heavy share turnover while risk is being cut, the hedging and arbitrage activity can transmit a much larger notional impulse into the underlying market. That is how transfer is experienced, not as a single move, but as a rapid migration of risk from public holders into the hedging machine, and then into the spot price. This is why the collapse reaches a clean, memorable number like $60,008.52. Not because the market decided that value, because forced flows needed a clearing price, and the market found it where liquidity finally appeared. Here is the cascade, step by step, with no ideology and no mystery. First, macro conditions turn risk off. Risk off means volatility rises, crowded trades unwind, and the cost of holding leverage increases quickly. Second, Bitcoin breaks through levels where leverage is concentrated. Leverage is not an opinion. Leverage is a contract with a liquidation engine. When price hits the thresholds, positions are closed automatically. Third, ETF holders sell because the ETF is the simplest exit. Market makers hedge, and hedges are implemented through the most liquid instruments available. Fourth, as hedging pressure accelerates, spot liquidity thins and price gaps lower into the next pool of bids. Fifth, when the flow finally exhausts, price rebounds, not because the narrative changes, but because forced selling is finite. That is stage 3. And it creates a specific signature: violent intraday lows, sharp rebounds, and an exhausted market that looks confused to anyone watching only headlines. Now the contrarian point becomes clear. This wasn't primarily crypto news. It was a liquidity event inside a financialized Bitcoin, triggered by risk-off conditions and amplified by wrapper mechanics. This is why the inflation hedge story breaks at the worst possible moment. An inflation hedge is expected to protect when traditional assets wobble. But a financialized Bitcoin can become correlated with the risk complex, because the same institutions, the same risk budgets, and the same hedging practices touch it. When the system demands cash and reduced volatility, the same hand pulls down multiple levers at once. Now look at the human consequences, because this is where the abstraction turns into pain. If you are 25 and building savings in Bitcoin because your confidence in fiat is low, your exposure is no longer only Bitcoin's monetary thesis. Your exposure is also the wrapper infrastructure, the leverage ecosystem, and the macro regime that can flip in hours. If you are 45 with a retirement account and a small Bitcoin allocation as insurance, this affects you because insurance must behave defensively under stress. This week shows Bitcoin can be forced to behave offensively, selling off with the risk complex rather than buffering it. If you are a business owner holding Bitcoin on a balance sheet, this affects you because liquidity needs arrive on a schedule. Taxes, payroll, inventory, debt service. Those obligations do not pause because the market is deleveraging. The structure matters because structure determines whether you can choose your exit or whether the market chooses it for you. Counter-arguments exist, and they must be addressed directly. One claim is that ETFs are purely bullish because they legitimize Bitcoin. Access is real, and access can lift price over time. But access through a wrapper also changes the shape of sell-offs, because it centralizes the exit. Another claim is that Bitcoin is digital gold, so it must eventually decouple. Decoupling is not a slogan. Decoupling is a behavior under stress. The behavior just demonstrated is correlation, not insulation. The last claim is that a drop is healthy because it flushes leverage. Flushing leverage is part of the cycle, but the pain of the flush is not distributed evenly. The flush punishes those who assumed liquidity would remain constant. Remember the 4 stages. Here is where the system sits today. Stage 2 is already complete. Bitcoin is financialized. Stage 3 is active. The unwind is visible, and the wrapper mechanics are amplifying intraday cascades. The question is whether the market transitions into stage 4, absorption, or whether stage 3 repeats in waves. Absorption does not require a straight-line recovery. Absorption requires stabilization, less forced selling, more balanced flows, and a reduction in reflexive hedging pressure. Over the next 12 to 24 months, 3 warning signs will show whether the system is absorbing or breaking again. Warning. Sign 1 is persistent outflows from the ETF complex. When net outflows are sustained at multi-billion-dollar scale, the cushion of passive demand remains thin, and the next shock has less support. Warning. Sign 2 is the rise of intraday air pockets, sharp drops followed by sharp rebounds. Those moves often indicate forced flow meeting opportunistic liquidity, not stable valuation discovery. Warning. Sign 3 is volatility-driven hedging dominance. When hedging becomes the primary driver of trading, the market becomes more sensitive to small shocks. Because the hedge grows as the move grows. Preparation is not panic. It is the discipline of treating structure as reality. A financialized asset requires a different mindset than an ideological asset. Position sizing matters because it determines whether you are a chooser or a forced seller. Time horizon matters because it determines whether volatility is noise or a threat. Liquidity planning matters because it determines whether obligations force you to sell in distress. Now return to the title and understand what it truly means. BlackRock triggered a transfer is shorthand for a system-level event where ETF-era access turns into ETF-era amplification. The ETF channel does not need to intend anything. The structure is enough. When the wrapper becomes the exit and the hedges become reflexive, price can collapse to a level like $60,008.52, even without a single decisive headline. And when that happens during a macro risk-off turn, the asset that was sold as protection can become a source of stress. That is the liquidity trap. The trap is not that ETFs are evil. The trap is believing that easy access guarantees stable behavior. Easy access guarantees fast behavior. Fast behavior is harmless in calm markets. Fast behavior is dangerous when everyone tries to exit at once. The core thesis can be stated in 2 sentences. Bitcoin's drop to $60,008.52 is a liquidity event inside a financialized system, not merely a reaction to a narrative. The ETF wrapper can amplify intraday cascades, and that amplification matters most at the exact moment investors expect protection. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute, and the cycle repeats because the structure repeats. If this analysis opened your eyes, subscribe now. In my next video, the same 4-stage framework will be applied to the next pressure point. How concentrated index exposure and options hedging can turn an ordinary pullback into a systemic air pocket. The liquidity trap is already built. The only question is whether you recognize it before the next unwind forces everyone to learn it the hard way. When a risky asset becomes a widely held wrapper product, the wrapper can dictate the behavior of the asset underneath. This unfolds in 4 stages. Stage 1 is liquidity expansion, when money is abundant, leverage is cheap, and positions are built quietly because selling pressure is easily absorbed. Stage 2 is financialization, when the asset is repackaged into products that can be traded faster than the underlying can be settled. The wrapper creates access, but it also creates an accelerant, intraday liquidity on top of slower-moving collateral. Stage 3 is reflexive unwind. When risk turns, the wrapper becomes the exit door, and hedging flows push the underlying in the same direction. At that point, the market is not discovering a price, it is being forced into one.